Good afternoon. I am very pleased to welcome NYU students, alumni, friends, and distinguished guests from all over the world to this virtual meeting, Fiscal Dominance, a Theory of Everything. I hope you and your family are safe and healthy during these challenging times. To participants, be mindful that you can submit questions at any time in the Q&A tab at the bottom of your screen, and we will try to address them towards the end of the session. I would like to take this opportunity to thank Jenny, Erin, and Erica for their active support in organizing this event. It is my privilege today to introduce Dr. Viral Acharya, CV Starr Professor of Economics in the Department of Finance at NYU Stern School of Business and an academic advisor to the Federal Reserve Bank of New York and Philadelphia. From 2017 to 2019, Dr. Acharya was Deputy Governor at the Reserve Bank of India, in charge of monetary policy, financial markets, financial stability, and research. Professor Acharya is the author of a recently released book, Quest for Restoring Financial Stability in India. Dr. Acharya has held a number of prestigious roles, including Director of the National Stock Exchange of India, Director of the Western Finance Association, member of the Economic Advisory Committee of the Financial Industry Regulation Authority, and member of the Advisory Board of the Securities Exchange Board of India. Dr. Acharya completed his Bachelor's of Technology in Computer Science and Engineering from Indian Institute of Technology and holds a PhD in Finance from NYU Stern School of Business. Welcome, Professor, and thank you for accepting our invitation.
Thank you so much, Pedro. It's a delight to be here, always a delight to connect with the alumni, especially in different parts of the world, in many ways closer to where I come from. So I hope you are all safe and well as we continue to deal with this challenging year that doesn't seem to be ending, but it's coming to an end very soon, hopefully in all ways. So as Pedro said, let me just show you this. I've just written and released a book on my experience as a deputy governor in India. The book is called Quest for Restoring Financial Stability in India. And let me connect it to the experience at Stern around the global financial crisis. I joined Stern in the finance department on 5th of September 2008, 10 days before the collapse of Lehman Brothers. So you can imagine what was the first thing I did after reaching on that Saturday in the New York City. I went to the local ATN store to get a Wi-Fi router because my room wasn't yet connected, our flat wasn't yet connected to Wi-Fi, because we had to keep up with everything that was going on with the financial crisis. And after, the Lehman Brothers collapse and all the reforms that were being discussed, Stern faculty wrote a volume of edited chapters. A large number of faculty across Stern contributed to it. That book was called Restoring Financial Stability: How to Repair a Failed System. So when I went to the Reserve Bank of India, the Indian Central Bank, as a deputy governor in January 17, and returned after finishing my term 6 months before the scheduled end. So I returned in August 19. My last day was 23rd July 2019. I wanted to summarize what I had attempted to do as a deputy governor. And it was not just restoring financial stability in an academic sense, it was actually a quest, because this time I was actually in the hot seat, not in the hottest seat, which is the governor of the central bank. I was a deputy governor. But, it gets kind of as close to being the governor as one can. And it was a quest, and it was also it was a quest because it was a real experience. It was also a quest because it was really a challenge, and that is what I really want to talk about. That why was it so hard to actually get India to embrace anchoring financial stability in its financial sector for the next 10, 20, 30 years to come. Uh, and uh, it goes without saying that, given what Pedro mentioned and given what the title of the talk is, that it's going to be about fiscal dominance, which is put in very simple language. It's about an overstretched government that's trying to do too much and is therefore trying to dominate the financial sector regulations and policies. And this is precisely the reason why our quest for restoring financial stability in India was very challenging. I would say it's, in fact, an unfinished agenda. We could not take it to its natural completion, though we made significant progress, as I'll try and explain. And essentially, the main resistance that we faced at each point was that when the government is continuously overextended, it is trying to do too much, it's running very high debt to GDP ratios or very high fiscal deficit ratios. It doesn't have the resources to provide any buffers to the economy when it gets shocks. And in these cases, the governments have a tendency not to actually undertake long term structural reforms or undertake consolidation of their own expenditures and balance sheets, because they have a tendency to resort to financial sector policies and make it easy for banks and shadow banks to extend credit in the rest of the economy. By doing that, they are able to create temporary growth impulses. They are able to throw credit at the problem. They are able to throw liquidity at the problem of slowdown in growth, rather than addressing some of the root causes, which is actually the lack of doing ease of doing business on the ground, or lack of a very robust and deep financial sector with robust institutions, or the lack of efficient fiscal expenditures. Of course, by its very definition, if a government balance sheet is overstretched, it is doing a lot. The problem is not that it's not doing enough. But usually the problem is that it's not spending on things that actually add tremendous growth to the economy. The expenditures are often very wasteful. They are very often very short term focused. They are populist programs. Uh, uh, they are very often just pension and salary payments because countries like India, the governments own a large number of public sector enterprises, and so they have a huge employee headcount on their own balance sheet to support. And most of the times, these public sector enterprises are not run that well. So the sum total is that the governments in these countries are, like India, are undertaking a lot of expenditures, but they are not efficient expenditures. They are not for provision of health, education, and infrastructure, which are the three most important public goods that a government should be providing to its citizens. So, coming back to India and the theme of fiscal dominance, I chose the term fiscal dominance as the title of the prelude chapter in the book. And the book consists of my speeches. They are fairly readable in my view. They are a combination of academic work, uh, policy making experience, and simultaneously a lot of international comparisons, because I like to draw lessons from what worked elsewhere and what didn't work elsewhere and why. And can we draw some lessons on that for emerging markets such as India? But the prelude chapter, which is fiscal dominance, and at the cost of a slight exaggeration, I call it a theory of everything in India. And I stress that it's only a slight exaggeration. It is practically a theory of everything in India. It really binds all the speeches together. Now, fiscal dominance in macroeconomics is a concept in which a government has so much debt that a central bank, rather than focusing on price stability or targeting inflation to reasonable levels, simply wants to keep printing money and monetize the government's deficits. It can do so by simply printing money and handing it over to the government to undertake its expenditures. It can do so by buying the treasury bills of the government to help it meet its various short term expenditures. Or it can do so by what is now called in modern central banking parlance as quantitative easing, which is that you go out and buy the government bonds in market operations in the secondary market rather than buying government bonds in the primary market or simply handing over the printed money to the government. Now, when a central bank does this, it often starts diverting or distracting itself away from its price stability targets. Inflation may already be high. Nevertheless, it continues to print money and maintain a high money growth because it doesn't want the government to cut back on its expenditures or because it wants to help the government roll over its debts at a low cost. Because if the central bank doesn't act as a big player in the market, the cost of the borrowing for the government may rise in the short term, even though that may be better in the long term because that may force the government to reduce its expenditures and debt capacity. But the government may get some temporary relief as a result of this. But of course, the central bank is stoking inflation in the economy. And very often in emerging markets, notably Argentina, which has actually defaulted, 9 times over the last 100 years, this is a typical pattern. The government runs a very extended budget. At one point, the central bank throws up its hands and basically, even when inflation is rising, instead of raising rates, it first cuts rates. Then external creditors lose confidence in the economy. They start pulling their funds out. And finally, the central bank eventually goes and starts doing an interest rate defense of the currency, where it then starts jacking up interest rates by 10%, 15%, even 20%. But by that time, it's too late, and the investors have actually lost confidence because they have no confidence in the credibility of the central bank that it will maintain inflation stability in the first place. Now, this is the traditional notion of fiscal dominance. It's limited primarily to monetary policy and liquidity management of the central bank. And it's about the central bank getting distracted from its goal of inflation stability. Now, in a country like India, and now this is increasingly true in most parts of the world, a central bank is not a single purpose central bank that is just given the charge of the monetary policy. Central banks are very often all purpose institutions. In India, for example, it regulates banks and non bank finance companies. So it regulates both banking and shadow banking. Housing finance is supervised by another entity, but that is also regulated by the central bank. It runs the deposit insurance fund. So it collects the deposit insurance premia and maintains the fund to pay off the depositors when a bank is not able to meet its deposit payments. It is the debt manager for the government. So it runs the auctions of the government debt. It is the regulator for the debt and the foreign exchange markets. So the government bond markets and the foreign exchange markets, the rules are actually set by the central bank. So, and it also engages in the reserves management and the currency stabilization in case there is an external sector problem. So, in all sense of the word, Reserve Bank of India is truly an all-purpose central bank. Now, there are many benefits of being an all purpose central bank, but when you have an overstretched fiscal balance sheet and a government that is very focused on short term populist measures, being an all purpose central bank has the problem that there are too many pressure points where the government is now going to pressurize the central bank to cut corners. It's going to want the central bank to get banks to buy the government bonds in the auctions by making phone calls. So you can call it moral suasion. Sometimes it's called phone banking or phone auction, whatever one wants to call it. Second, it may want the government to actually relax the rules for bank regulation. It may be capital rules, prudential liquidity management rules, recognizing non performing loans and assets on time. The government may want the central bank to relax all these rules so that banks can continue creating credit in the economy without actually raising capital and acknowledging losses on the legacy loans in the first place. Let me just focus on this last point, for example, because in India, this is a particularly severe problem because a big part of Indian banking system is owned by the government. more than 50% of the deposits and assets in terms of loans of the private sector, including households, etc., which are with the public sector banks. And this is a this is a legacy problem. These banks, most of them were private before late 1960s. In two rounds of in two waves, they were nationalized in late 60s and then in late 70s. And it has basically been a failed experiment in the sense that it was mainly done for political reasons, so that the government could basically use banks to extend credit and serve a financial inclusion or a development function. But in the end, the public sector banks have mainly been used to provide fiscal stimulus to large corporates. And after the global financial crisis, that stimulus was done so poorly and the loan underwriting standards were so bad that the Indian banking system has now close to, in fact, it has the highest non-performing assets ratio. It is the second highest. It's next only to Russia in its non-performing loans in the G20 countries. For next year, it is in fact projected to most likely have the highest non-performing loans. So, in the end, basically, these public sector banks have become a political tool to focus on short term credit growth as a way of creating froth and economic activity rather than having stable financial sector presence. Now, if the public sector banks are lending so poorly, every now and then they are going to need capital because the loans go bad and the banks are making losses. So, without recapitalization, they would not have any capacity to make further loans, and the credit growth might turn out to be very anemic. Now, of course, if the regulator marks the books of the public sector banks properly, then the government would have to inject capital and set aside some funds for stabilization of the financial sector. But if the government has to do it on its fiscal balance sheet, it would have to cut the populist programs. So rather than actually rationalizing its expenditures or divesting its stakes from the public sector banks and reprivatizing them, if it's too costly for the government not to inject capital, it can reprivatize these banks by creating a distance from the operations of these banks and let the private sector run these banks. But it does neither. It turns to the central bank and tells the central bank, why don't you disregard the Basel norms for a couple of asset classes where the non-performing loans are very high? We'll kick the can down the road. We'll worry about it in a year or two. Of course, growth will rebound to fantastic levels in 2 years. At that time, we will have tax revenues and we can worry about the recapitalization at that point. And in the meantime, the same banks that had made the bad loans continue to extend credit. Very often, they extend credit not to the new healthy firms, but they continue to extend credit to the old distressed firms because that will prolong the life of these firms and postpone the day of reckoning to 3 or 5 years down the line. Or very often they simply buy government bonds and they don't want to lend to the private sector or the households at all. So, undercapitalized public sector banks in India either do zombie lending, which is that they lend to the worst firms in the economy, or they do lazy lending, which is that they lend to the government. And the middle tier of healthy corporate MSME, so small, micro, medium sized enterprises, and the individual who are good borrowers, they are either rationed. So India's credit to GDP is barely 55%, which is very, very low, or they have to borrow at very high rates because banks are reluctant to lend to anyone other than their distressed borrowers to evergreen them, or to the government because lending to the government doesn't require any capital on the balance sheet. As you know, in Basel capital requirements, you can hold government bonds at practically zero cost of zero capital on the balance sheet. You can just buy deposits, can just issue deposits and buy government bonds with that money. So as a result of this, our quest for financial stability, when I reached India, was already at very high non-performing loans ratio, in fact, more than 10% at that point. We said we must make a push to change the ownership structure of these banks. The healthier banks should be recapitalized. The weaker banks should be put under a prompt corrective action framework so that they don't bleed any further. banks that don't have the good technology to underwrite, monitor, and collect on the loans should ideally not be allowed to use depositor and taxpayer money to make more bad loans. It's better to keep them small in size or to sell them off to better players in the market. There was an asset quality review that was already started prior to my joining that had been completed. But in the meanwhile, some other forbearance and restructuring packages got structured so that banks were once again not actually recognizing bad loans in time. So we made, and then India had implemented a new insolvency and bankruptcy code in December 2016. And on the back of the insolvency and bankruptcy code, we said that all the sectors such as infrastructure, power, steel, which have a lot of excess capacity because too much asset has got created relative to the demand in the economy, that the distressed firms should be pushed into bankruptcy so that either they get liquidated or they get acquired by the healthier firms. This way, the healthier firms will regain their pricing power, and then the virtuous investment cycle can start again. But what happened is, after about 10, 12 months of success on many of these steps, we were looking at about 10 to 12 months or maybe 15 months to the national election. The growth had been tapering down in India because of shocks such as demonetization, which didn't go very well, especially with the informal economy, the implementation of the value added or the goods and services tax in India, which was botched in terms of execution. And as a result of that, also several businesses were struggling to get formalized. And so basically, the government got cold feet about this restoration of financial stability. It said we must relax all these rules, relax capital requirements, relax prompt corrective action framework. Instead of giving capital to the stronger banks, let's give capital to the weaker banks so that they can start lending quickly wherever they are situated. And of course, privatization of banks was completely off the table. And maybe the worst of it all, there was a stay on the insolvency and bankruptcy code because the power sector companies, they lobbied the government, and in one way or the other they got their way through. And the time bound resolution of distressed companies that India had embarked upon got basically very protracted and delayed, so much that the whole agenda was not complete. And unfortunately, COVID has struck in the meantime. Now there are new debt moratoria and further forbearances and lack of recognition of non-performing assets. The Reserve Bank of India's financial stability report now projects that the bank NPAs will again hit 12.5 to 15% range. And unfortunately, even before having cleaned up the bad loans that were made in the fiscal stimulus after the global financial crisis, so 10 years since then, the problem is not solved. And we are now looking at another cycle of this kicking the can down the road again. So essentially, in India, bank regulation is very severely fiscally dominated. The presence of the public sector banks is a fundamental root cause of this problem because the government doesn't want to do anything with them. It just wants them to exist so that whenever they want, they can use them to direct credit to the relevant parts of the economy from which they get their political votes, so to speak. And so I think this is the real battle that India is fighting. So to if I could summarize, fiscal dominance in India is not just the problem India is facing right now, which is that inflation in India has been between 6 to 8% consumer price inflation for the last 12 months. And yet the conditions in terms of liquidity are extremely generous. Money growth in India right now is at double digit growth levels. The central bank is actually pumping more and more liquidity into the economy, doing open market operations of government bonds. And these are not the policies you would expect when your inflation is actually 6 to 8%. You would expect the central bank to be withdrawing liquidity, raising rates, and perhaps supplying government bond paper in the market to absorb the surplus liquidity. But that is not the only problem of fiscal dominance in India. The real problem of fiscal dominance in India is that India simply doesn't acknowledge in an earnest manner what is the true state of its public sector banks. Because it doesn't acknowledge that, and because depositors in these banks have the sovereign guarantee standing behind them, nothing happens. So India goes through what I call as a silent crisis, where these banks don't lend well at all. Credit growth in India remains very weak. It remains in single digits, very often only 4-5% on an annual basis. And that's because a big chunk of deposits is with public sector banks who are very reluctant to extend credit other than buy government bonds and occasionally do zombie lending to evergreen. The central bank really needs to draw the line, in my view, and once and for all fix the banking sector. Because if the banking sector is like the lifeblood of an economy, and if blood can't reach the different organs of the body, they can't function in a healthy manner. As I said, our quest for restoring stability is an ongoing battle in India. My purpose of writing the book was to keep sending that message to the central bank and the government and the broader group of analysts, media, etc., so that collectively as a system, you can get some movement and gravity towards the right point, which is to secure the foundations of a healthy, well capitalized, well lending, stable financial sector for 10, 20, 30 years. Because if you don't do that, your potential output growth ultimately starts coming down because money is not being channeled to the right places. It doesn't go to the right place. So let me stop there. My sense is that fiscal dominance is has historically been a bigger problem in emerging markets because they have high inflation. They go through up and down leverage cycles also more often, and government pressures on institutions are very high in emerging markets. But interestingly, COVID has brought the term fiscal dominance back into the domain of discussion of developed country central banks, because everyone is now concerned that with post global financial crisis, developed countries governments have already expanded their balance sheets very massively. The central banks, through quantitative easing, have purchased massive amounts of this government debt. They had not normalized their balance sheets fully. Only the Fed had really normalized to some extent. ECB and Bank of Japan are still buying a lot of government debt every day, and they were doing that even pre-COVID. And the question that is getting asked now is that when the pent up demand returns, when the developed countries are vaccinated to a point where economic activity rebounds, maybe inflation impulses will pick up. The world is also reducing its reliance on China, diversifying supply chains, so the cost of imports may rise. Maybe that will also add to inflationary pressures as firms actually go and manufacture in places where it's far more expensive than to manufacture in China, just because they want to diversify supply chains and not be overly dependent on China. That may also add to inflationary pressures. When all of this happens and inflation gets above the target rates in developed country central banks, will there be pressure on the Fed, on the ECB, on Bank of Japan not to raise interest rates? And similarly, a lot of zombie lending is taking place right now because the central banks have given a put option to all financial market creditors, be it banks or be it bondholders. Junk rated companies are right now borrowing at their lowest ever credit spread in the US corporate bond markets. Are all of these companies going to necessarily survive and do well? It's not at all clear. While even if we recover from COVID, is travel likely to get back to pre-COVID levels? It's not going to be there for at least another 3-4 years. Maybe we never will travel as much as we used to, given that we have all switched our habits to Zoom and video conferencing and so on. Will fossil fuel industry be where it was? Probably not. Maybe climate change will get embraced with the new administration coming in the United States and Europe, already very keen on the climate change agenda. Will we keep going to malls? Probably not, because e-commerce is actually becoming very convenient for everyone. Uh, and so there are several sectors in the economy where the loans and the bonds which are being supplied right now at ultra low costs, they're going to be struggling to get revenues to repay these debts. Now, the question that is going to get asked is, will the central banks and bank regulators come under pressure to relax the asset quality recognition norms and lending standards of banks as far as these distressed companies is concerned. So my sense is that the issues that we encountered in India over the last 2, 3 years may now actually become front and center, not just in other emerging markets, but also in developed countries, including possibly the United States. So it's going to be very interesting times. I wrote the book before COVID. I had no idea that fiscal dominance could become a big theme in the developed markets itself. But it's going to be very interesting to see whether the central banks are able to maintain their credibility as independent monetary policy authority, as independent bank regulators, or not. Because if they don't, I think that would be an institutional erosion that brings developed countries closer to emerging markets than where they have been in the past. So let me stop there, Pedro. I can take a few questions from you or the audience as you want.
Thank you, Professor. Thank you so much. Very interesting presentation. And we are indeed having a number of questions from our participants. I want to, as you clearly pointed out, I mean, fiscal dominance is not particular to India. Across the world, stimulus responses have varied from 1% to all the way to 30% of GDP. Specifically, the US is about 30%. Japan, 35%. Germany, I believe, is about 25%. And if you put the bucket of emerging markets, China, India, I think India is represent about 10%. China, amazingly, is really relatively low. The percentage around 4 to 5%. Mexico 1.5%, and even Brazil, I believe, is about 5%. So there's been different responses across the world. Nonetheless, it's been a certainly significant amount of intervention, specifically in developed markets. If you compare it to the emerging markets, there are two buckets. So I guess in particular, the US, as you mentioned, the Fed has been very active since the global financial crisis. And prior to the global financial crisis, I believe the Fed balance sheet was about $930 billion. Now it's about $7.8 trillion. So more or less 7 times the amount of intervention, and certainly one of the highest interventions in the world. So I guess definitely is not particular to India, the problem. So I guess the key question here is going back to your point about the implications of fiscal and monetary policy doing a lot in terms of expenditure, meaning short-term activity, as opposed to the longer term, which is that has more multiplier effects in the economy, as education infrastructure that you comment. So, I mean, what are the implications? What are the implications of this? Sort of having governments intervening in capital markets. I mean, at some point, in the Greenspan era, we talk about laissez-faire. Let's do there's no intervention. All of a sudden, we're in this world, in a post-global financial crisis, post-COVID crisis, with $7 trillion in the US, just the Fed, and plus the fiscal stimulus, as you know, is about $2.4 trillion coming from the CARES Act, and potentially another $1 trillion coming, after Biden is sworn in. So, where are we going? Where are the long-term consequences of this new era, of this new sort of way to do policy in terms of monetary and fiscal policy?
Yeah, that's it's a very important question, Pedro, to reflect on. And my sense is that there are two possibilities that have become more likely because of COVID and these balance sheet expansions, neither particularly pleasant. One is that we come out of the COVID with very large government debts, and the pent-up demand comes back, the economy starts growing again, the private sector credit growth starts growing again. At that point, you get a competition. So, private sector and the government start competing for funds because they're all trying to grow quickly. Right now, that's less of a problem. The government bonds are attracting a lot of capital for themselves, and companies are borrowing, but they aren't really investing that much in the meantime. Not certainly at the levels of pre-COVID. So at that point, as I was saying, if inflation impulses rise, one possibility is that the central bank sticks to its inflation mandate and is forced to actually raise rates. That would mean two things: that it's not able to allow uh, the investment activity and the growth rebound to proceed as quickly as one would like because of the inflationary pressures. And second, that it may actually make the rollover costs of government debt higher, which would mean that the governments would have to actually think very hard about their expenditures. They would have to rationalize the expenditures. They might have to put money where the return to the economy in terms of growth is likely to be the highest, rather than throwing money after sectors which are not likely to grow that much over the next 4 or 5 years, because that could just be money that goes down the drain. So they would have to prioritize any further expenditures very, very significantly. In fact, I think they need to prioritize even with the second stimulus that the US is planning, because as you said, the fiscal numbers are just galloping away at the present pace. And in that scenario, what you get is that you could get some difficult balance sheet adjustments happening both on the central bank, the government, bond markets, etc., while you are trying to balance growth and inflation trade-off, which is that the government and the central bank have to gracefully unwind their balance sheets in a manner that they don't create bond market upheavals for those who are owning these instruments. Of course, this is the reason why central banks sometimes get dominated in the first place, because they are so worried about a bond market disruption that they say, to hell with inflation for the time being, I just want to help the rollover of the government bonds. I think if things turn out to be something along these lines, I would think it is going to be a difficult scenario, but it would be a better scenario in my view, because discipline on the governments, where they have to pay a higher cost of rollovers, is what may ultimately force them to spend their expenditures in a better way and to rationalize them, compress them wherever there is waste and inefficiency. A second scenario, though, which worries me more, is one in which the governments and central banks join hands to use financial repression, where, because they know that government bond markets are becoming very large and they need a set of players to continue to buy government bonds, they start using some implicit ways of channeling the savings of the economy into government bonds. Historically, many emerging markets have done these by requiring that banks actually maintain extremely high levels of liquid buffers, and this liquidity has to be held in the form of government bonds or cash. They could do it, for example, by raising capital requirements on private credit. You could actually make private credit more expensive than even more expensive than government credit in terms of bond markets. You could attach higher capital weights on corporate bonds. And another thing you could do is that, of course, the central bank may try to prevent private credit growth to an extent, perhaps by preferring government bonds as collateral in open market operations or for emergency funding, but gradually taper off the corporate bonds from its emergency facilities and so on. What happens with this kind of financial repression is that by and large, intermediaries don't make much money. Of course, extremely ultra low rates and collapsing the term premia as quantitative easing has done has also produced very similar effects. And once intermediaries are not making a lot of money or capital, don't have much capital, again, they can't create much credit. And then you may get financial repression, low productivity, low growth, where the government balance sheets remain a very large presence of the economy and the private sector actually gradually starts shrinking in size. This is in fact what has happened in many emerging markets where governments keep getting bigger and bigger and the private sector starts getting crowded out. The first scenario I described is more likely to be inflationary and somewhat disruptive in markets, but I think it may put us in a better situation in terms of striking the right balance between the size of government, central bank, and the private sector. The second scenario is likely to be one of low growth, deflation, uh, and financial repression. And it's more likely to get us stuck in the post COVID scenario of very large government balance sheets and relatively small private sector contribution to growth. And I think neither scenario is particularly pleasant, but between the two, if I had to choose one, I would prefer the first scenario rather than one of deflation and low productivity. But I think these are the risks we have to factor in. And I think, as someone put it very nicely, that the inflation outcomes and the growth outcomes have basically acquired fat tails after COVID, which is that the low growth outcome, low inflation outcome has now a much higher probability. And it's also possible that you also get a very fast rebound, but then you may get a very runaway inflation that comes with it. And so we are looking at sort of more extreme outcomes coming out of COVID than we were positioned pre-COVID.
Thank you. Are low rates policies creating an asset bubble? I mean, if you could comment on that, and also if you could also elaborate more on the very interesting conversation about non-performing loans and something lending. I mean, it seems that at the same time, it's kind of connected the question. I mean, at some point you can address it towards the equity markets and also towards from the companies, and how to avoid at the end of the day these low productivity trap, if you will. Um,
Yeah, I
uh,
have no doubt that the ultra low interest rates and the commitment to maintain them at very low rates, of course, if you measure the rates relative to inflation, we have negative real rates in most parts of the world. If you look at the amount of government debt that is yielding nominal negative interest rates, it is now just exploded since COVID, even though it had already become a significant number pre-COVID. So, of course, savers have to search for yield, and they are searching for yield in the form of risky assets. I think you can see that manifest in very low yields, even for junk rated bonds, and very attractive valuations for equities. In a way, it's a global asset price bubble because COVID is a global shock. It's a synchronized global shock in a way. All governments and central banks, even if in different intensities, have adopted very similar fiscal and monetary stimulus measures to allow zombie lending and not force recognition of bad loans in the short run, etc. And this has, I think, two kinds of problems. One is that when there is so much government protection and stimulus provided, market signals are not always too informative about risk because there is a gambling for resurrection in zombie firms. They might be keen to get whatever cheap credit is available right now because maybe once vaccines arrive, the cost of credit may rise. A second thing that may also happen is that you don't get uh, enough pessimistic views being expressed in the markets because bears know that if they try to, whenever the markets turn down, the central banks might once again come and accommodate, or another fiscal stimulus may get passed. And so it may become very hard to bet on bad news in such a time when you know that governments and central banks will be very keen to act. So then everyone just goes all in and goes long various kinds of assets. And of course, this can result in a misallocation of capital. What is the number one problem with bad lending? So, zombie lending is basically lending by a bank to a loan that has already defaulted, and yet the loan carries very little interest rate and it has a very long maturity, like 3 to 5 years at practically zero interest rate, because the bank's main incentive is to evergreen the loan and not recognize it as a non-performing asset. So even before the default is going to happen, you just extend the maturity of the loan at a very low interest rate. Now, what is the problem with that kind of policy? Of course, it's temporarily good for that firm. It's temporarily good for the employees of that firm. But it's a very bad policy for that sector as a whole because there is no adjustment in terms of supply of firms in that sector. Bad firms don't leave; they are not creatively destroyed. Good firms don't become stronger and better and larger, so they
Yeah.
can't invest more. They are not able to attract the human capital of the zombie firms. They don't get their pricing power back. And ultimately, sectors where supply of firms doesn't adjust to the demand for the products end up being zombie sectors. They don't grow well. They become very low productivity sectors with very little investment, very poor employment. And ultimately, it starts bringing even the healthier firms down. Even the healthier firms actually get trapped as a result.
Mm.
So, a problem with the bubbles and the zombie lending policies is that if pushed for too long, they result in a massive misallocation of capital, and you can't unwind from the policies very easily, because then you are talking about bankruptcy of a large part of an entire sector. It's better to deal with a few bankruptcies than to have an entire sector that is now looking completely unproductive. And I'll just give an example here. You could argue that European Central Bank basically played a quasi-fiscal role in supporting Italian and Spanish bonds in the government bond markets through its, open market, outright monetary transactions, OMT policy in 2014, then quantitative easing that followed thereafter, etc. Okay, Italian debt markets are no longer as turbulent as they used to be. Is Italy in a better shape after 5 6 years of ECB's policies? I don't think so, because I think ECB has not asked for any structural reforms of the Italian economy as a quid pro quo for its accommodative policies. And I think this is the fundamental problem with the accommodative policies. If they are used as a stopgap measure to structurally fix the deeper underlying problems, I think they could be well justified. But very often they are just a band aid without actually fixing the wound in any way. The wound then starts festering and the problem becomes even bigger down the line. And I think that's the challenge the world is going to face in 2 3 years' time.
Excellent, Professor. This is great. I mean, I know you're an expert in the financial, a number of topics, but specifically in the banking industry. So, how healthy it is the financial system, particularly in the U.S., and if you could comment, if you have an understanding around, outside of the U.S., but how healthy it is, and it goes to this point connected to the situation of having zombie companies with an unhealthy system. I mean, is there you see any systemic risks at all in the financial system?
Yeah, it's very interesting. On the one hand, you see the bond markets are very frothy, equity markets are very frothy. But if you look at the senior loan officers survey done by the Federal Reserve, bank loan officers survey, the lending standards are actually very tight. Banks are not lending money to firms. They are not lending money to small businesses other than through government guaranteed or the central bank guaranteed programs. They are actually not passing on too much of the benefits of low interest rates to newer borrowers. Of course, there is new mortgage activity that's happening because people moving from cities to suburbs and things like that. But the lending standards are very tight. So I don't think banks are per se at the risk of failing right now. But I don't think banks are seeing their future as being very bright. And there are several problems here. One is that there has been a commitment from central banks to maintain interest rates very low for long and continue to do asset purchases, which means that interest rates will remain low and the term premia will be very compressed, which means banks are not going to earn much margins in many businesses. So banks are expecting that the future intermediation margins over the next several years are not going to be that robust. Second, banks are anticipating losses on certain asset classes. Take the oil sector in the United States. It was already very stretched in terms of its asset quality prior to COVID. And then, of course, COVID collapsed the global demand. Probably there's also going to be a big shift away from fossil fuels to renewables and other kinds of clean energy solutions. So the future for this industry doesn't look that bright. US banks are very heavily exposed to the oil sector. They know this.
Yeah.
And therefore, even if they have not yet recognized the losses, they know the losses are coming They are busy provisioning for these losses ahead of time, and therefore they don't have much capital actually to lend. And the third point I would make is that when the COVID outbreak happened, a large number of companies, because they were facing very frozen debt markets, drew down very heavily on bank lines of credit. Even some of the best rated companies, investment grade companies, drew down on whatever credit facilities they had up to 50%, 70%, sometimes even up to 100%, and just converted it into their cash balance with the same bank or with another bank. Now, once a credit line is drawn, it becomes a term loan on the balance sheet of the bank, and the bank has to set aside capital for that. Now, what is happening is that as bond market conditions are easing, a reverse rotation is taking place. Many firms are now issuing bonds and repaying the term loans that they took out from their credit lines. But this process is not yet complete. And so banks are still actually finding that a part of their capital is locked down by the term loans that corporate treasurers drew down right at the outbreak of COVID. Only some of it is now gradually getting paid back to the banks. So, at least in the short run, while banks are not at the risk of failure in the developed economies, I don't think their intermediation capacity for the real economy is as high as it was pre-COVID. And of course, it's very natural. But I think it means that unless banks are recapitalized in a decisive manner when the economy is recovering, banks may actually end up holding back the economy rather than being able to supply credit to support the recovery and the growth.
Interesting, Professor. Just another question about the priority of fiscal deficits. I mean, it seems that some people are arguing that there are some sort of left views in the Biden team and with Paul Krugman views is that it's not a priority fiscal deficit. So what's your view? I mean, everybody's looking at other things except fiscal deficits. What's your view on that conversation?
Uh, I think my sense is, see, clearly the developed countries have the safe haven status. So, when the world doesn't do very well, even if United States is not doing very well, money flocks to the US treasuries because it is the reserve currency. It's the storage of safe assets for the wealth of a big part of the world. And the US will likely continue to enjoy that in the short run. But I don't think this idea that US can raise whatever debt it wants and it will continue to be the reserve currency of the world forever is really economically meaningful. Clearly, there are limits to how far you can push this argument because ultimately it is the taxes that back the debt cash flows. And if the growth doesn't rebound and the debt numbers just keep rising very dramatically, at some point I think investors will have to ask some difficult questions. And I think the point here is not that the developed countries will not be able to meet their payments. I don't think that's the question. The question is whether they will start seeing downgrades, whether they will start getting downgraded by credit rating agencies. See, every time your bond gets downgraded, a sovereign bond, foreign institutions have to hold higher capital requirements for owning these bonds. So domestic institutions don't have to hold capital for owning your sovereign bonds. But if your sovereign bonds get downgraded, foreign country banks will have to start holding capital against those bond holdings. And that's going to get reflected in the cost of borrowing of the United States government as and when that, if and when that happens. You can already see that several developed countries in Eurozone underwent several downgrades over the last 10 decades over the last 10 years, over the last decade. And that resulted in difficult bond market conditions for them. They didn't default in the end, but they ultimately their bond market auctions had to be rescued by some central bank coming in and saying, okay, I'm going to be the buyer of the last resort. But this is my point. If you reach a point where the central bank policies get fiscally dominated, because it is difficult to deal with a downgrade of the sovereign in terms of the market outcomes, you will just delay the process of adjustment of the sovereign balance sheet. The sovereign will continue to remain larger and larger in the economy. And at some point, the financial sector, because of low interest rates, is getting crowded out. And there will be some consequences on growth, productivity, and allocation of capital coming from all that. So I'm not saying that we don't need to spend money. I think all that I'm saying is that this idea that you can keep borrowing and no questions will ever be asked is bizarre. At a minimum, there will be a set of downgrades that will start happening. And therefore, if you can better allocate the fiscal expenditures, it would be more useful. Clearly, there is a set of households and unemployed people who are affected more in the United States economy, for example, than others. It makes more sense, I think, to give money to them rather than to simply bail out an airline, in my view, because an airline can still undergo a Chapter 11. It is not a liquidation, it is a financial restructuring. Some bondholders will lose money, but who's owning these bonds? These are actually relatively rich people of the economy. Poor people who have lost their jobs, they are not the ones who are owning equity and bonds of airlines. They very often don't participate in financial markets in the first place. So if you have an additional $50 billion, an additional $100 billion, is it better spent on these companies, or whether it's better spent on at the last mile, at the poorest people, on whom you will get an immediate consumption boost because they have to cut back on their essential expenditures if they don't get fiscal support. So I think these kinds of allocation questions, I think, is the fiscal expenditure efficient? I think that question can be answered even if you decide whether the level is here or whether the level is here. And so I'm a bit surprised that they just talk about the size of the fiscal deficit and not about the quality of the fiscal expenditures.
Excellent. And a couple of final questions, Professor, is related. I mean, what are your views? Is there a role of central banks that can play with digital currencies, and whether or not you think central banks have a role in reducing inequality? I mean, I know in your book you have a chapter that you talk about the shampoo sachet revolution in India, and it's a very interesting idea. And I wonder what's your view on those two topics.
Yes, let me talk about the income inequality first, because I was already touching upon it a little bit in my previous answer, which is that I think these policies, which are directed mostly at markets, have a tendency to actually worsen income inequality, in my view, because poor people don't participate in markets. So if you're creating wealth through stocks and bonds, I'm sorry, it's not going to reach the last mile. And I think the trickle down effect from the wealth you are creating for the already wealthy down to the poor people has to be so strong that, if you don't have that, these kinds of central bank policies don't work. So I think certain shocks require redistributive policies. Very often they are best handled through the fiscal expenditure as direct benefit transfers to the poor people. The central banks, by continuing to take on quasi fiscal policies, sometimes prevent these fiscal policies from coming into play, because the fiscal has to adjust somewhere else in order to create space for supporting the poor people. Because, whenever there is a pot of fiscal money, the rich people want their hands onto it also. And, it becomes a lobbying game rather than allocating it where the benefit to the economy is really the biggest. So I think central banks have a very big role to play on income inequality. At a minimum, they should not aggravate it, in my view, and I think they should focus on that. As far as central bank digital currencies are concerned, I think it's very likely that some models will be tried out by some central banks very soon. There is an excellent report by a G30 report, I think jointly chaired by Ken Rogoff and Raghuram Rajan. I recommend the audience to look at it because I think it's a complex topic and I won't be able to do justice to it just in a few minutes. But in the report, they are more of the view that the central banks may need the digital currencies, partly because if private digital currencies are beginning to take shape, they will want to have a central bank mechanism so that at least if the value of the currency is simply to provide a utility value and it's efficient to do it digitally, then that should be provided by a utility such as a central bank rather than be provided in the private markets. My own view is that a lot of the crypto, etc., the fundamental value for that comes because many agents don't want their transactions to be traceable. That could be for a variety of reasons. It may be purely for the purpose of anonymity, but it can also be for purposes of money laundering, tax evasion, terrorist financing, and things like that. And so, if at all you can migrate more of the users to the central bank digital currency, and in some sense make it less attractive to be in the crypto markets, I think it could be that that's a sort of a very nuanced way of actually ensuring that these crypto assets don't develop primary for the wrong activities. Because you don't create much liquidity for them if you move the liquidity of the innocent players into the central bank digital currency. But I encourage you to read the report for greater detail.
Professor, thank you so much. Thank you so much for this great presentation. We really appreciate it, and thank you all for participating today. I wish you and your family a safe and happy holiday season. And thank you, Erica. Thank you, Jennifer, for putting this together. Thank you to NYU.
Thank you, Pedro. Thank you to all the organizers and the alumni team for doing this. And I wish you all and your families the very best in these challenging times. Take care.
Take care. All right.